As of 11:25 a.m. Eastern Time on November 10, 2025, Archer Aviation, ticker ACHR, is trading at $8.29 per share. That's a gain of about 1.34% on the day, or 11 cents. The stock opened this morning at $8.47 and pushed as high as $8.63 before pulling back to its current level, all on significant volume of over 20 million shares. Now, if you only looked at that intraday chart, you might think it's just a moderately active Monday for a popular speculative stock. But that $8.29 price tag is a classic example of expectation versus reality. The expectation, the narrative that absolutely hammered this stock last Friday, is that Archer is in trouble. The stock plummeted nearly 8% in that single session, closing at $8.18, and many traders likely saw that as the beginning of a larger collapse. The immediate assumption was that the company's capital raise was a sign of desperation. But the reality of what's happening underneath the surface is far more complex and, frankly, far more strategic than that 8% drop suggests. The market reacted to the dilution, but seems to have completely misunderstood the acquisition that dilution is funding. Let's establish the common ground. When most investors, especially those managing their own portfolios through platforms like SoFi Invest or the Robinhood app, look at Archer, they see the quintessential moonshot stock. It's a pre-revenue company in the electric vertical takeoff and landing eVTOL space. These are, for all intents and purposes, flying taxis. It's an industry that promises to completely reshape urban transport, but it requires burning through astounding amounts of capital for research, development, and regulatory approval long before a single customer pays a fare. So when Archer announced on Friday it was raising $650 million through a stock sale, the immediate, reflexive reaction from the market was negative. Dilution is almost never cheered. It makes each existing share of ACHR stock worth a smaller piece of the pie, and it signals that the cash burn is high. This is the expectation. Archer is just another speculative tech firm like so many others before it, diluting shareholders to survive. But here is the reality that challenges that assumption, and it's the reason for today's relative stability. Archer didn't just raise $650 million to keep the lights on. They simultaneously announced they are using $126 million of that capital to acquire Hawthorne Airport in Los Angeles. This isn't just buying a building, it's buying a strategic fortress. This airport is central to their plan to build out their air taxi network, and it specifically positions them as the key provider for the LA 2028 Olympics. Furthermore, the company plans to use Hawthorne as a test bed for AI-driven air traffic control solutions. This move was so significant that Cantor Fitzgerald immediately reiterated its overweight rating and $13 price target, citing the acquisition as securing a critical, one-of-a-kind asset. The market sold off on the dilution. The smart analysis suggests they should have been focusing on the massive strategic advantage Archer just purchased. The company used its high-flying stock as a currency to buy a hard asset that its competitors like Joby will now have to find a way to match. This changes the game from a pure R&D race to an infrastructure race, and Archer just lapped the field. This context makes today's trading action fascinating. The stock is finding a floor here, bouncing off that Friday low. It suggests that while the initial shock of dilution caused panic selling, institutional buyers and analysts who read the fine print are stepping in. This is the classic tension. Retail traders on Robinhood stock trading platforms might be selling the news, while managers handling Fidelity Wealth Management accounts or Schwab Intelligent Portfolios are potentially scaling into a long-term position, seeing the acquisition as a de-risking event. The 20 million shares traded so far today shows this is a battleground. This isn't a quiet drift, it's an active debate between the dilution narrative and the infrastructure narrative. This entire episode follows Archer's third quarter 2025 earnings, which were released just last week. The headline numbers were exactly what you'd expect from a pre-revenue company, a net loss of $130 million. But again, the expectation versus reality framework is crucial here. The expectation was a massive loss. The reality? That $130 million loss was actually a significant reduction from the $206 million loss in the second quarter. GAAP operating expenses were flat quarter over quarter. This signals something incredibly important: capital discipline. They are managing their burn rate even as they approach the most expensive phases of certification and manufacturing. The free cash flow was a burn of about $126 million. But here's the kicker. The company's cash position before this new $650 million raise was $1.64 billion. Archer now has by far the largest liquidity position in the entire eVTOL sector, with over $2 billion. They hold more cash than debt. So the narrative that they are desperate for capital is demonstrably false. They are in fact operating from a position of immense financial strength. This is where the story gets really interesting for anyone actively trading this name, whether through a sophisticated platform like Interactive Brokers or a simple individual brokerage account. The short interest in ACHR is high, sitting at 13.9% of the float. That's a significant number of traders betting the stock will go down. However, the most recent data shows that short interest has decreased by over 20% in the last reporting period. This means that even before this strong earnings report and strategic acquisition, some of the most dedicated bears were getting scared and closing their positions. This current volatility, combined with a high but decreasing short interest, is prime fuel for a potential squeeze if the infrastructure narrative wins out over the dilution narrative. If this $8.20 level holds and starts to climb, those remaining 13.9% of shorts could be in a lot of pain. So what does Archer Aviation actually do? For those new to the story, this isn't a software company or a concept. Archer designs, develops, and is moving to manufacture eVTOL aircraft. Its flagship aircraft is called Midnight. It's a piloted 4-passenger aircraft designed for urban air mobility. Think of it as an Uber for the skies. The goal is to make 20 to 50-mile trips across congested cities fast and relatively quiet. The company came public via a SPAC, like many in its sector, and has been in a long, hard execution phase ever since. It has major partnerships and investments from companies like Stellantis, the automotive giant, and United Airlines. United CFO was just recently quoted as saying their conviction in Archer is validated, reinforcing that this isn't just a small venture investment for them, it's a core part of their future strategy. This isn't a stock you compare to Apple stock, which is a cash flow machine. It's not even Nvidia stock, which is in a high-growth, high-profit phase. This is much more like an early-stage Tesla stock, where the entire valuation is based on the market's belief in the future, the technology, and the ability to scale manufacturing. This brings us to the future outlook, which hinges on one thing: certification. This is the bottleneck for the entire industry. Archer has been making steady progress. Earlier this year, it received its Part 135 Air Carrier and Operator Certificate from the FAA, which allows it to operate a commercial air taxi service. It also received its Part 141 certificate, allowing it to open its own pilot training academy. These are huge bureaucratic hurdles to clear. However, the big one, the type certification for the Midnight aircraft itself, has seen its timeline slip. Back in February, the company was aiming for later this year. As of October, reports indicate that full certification is unlikely before the end of 2025, pushing the first commercial passenger flights into 2026. This delay is a risk, and it's a core part of the bear thesis. But Archer has a countermove. The company has stated that its initial commercial launch market is expected to be in the United Arab Emirates in 2026, where the regulatory path may be faster. This dual-track approach, aggressively pursuing FAA certification in the U.S. while simultaneously building a launch market in the UAE, is a smart hedge. It allows them to start generating revenue and proving their operational model even if the FAA process drags on. All of this circles back to the 2028 Los Angeles Olympics. With the Hawthorne Airport now in their control, they have the home base, the infrastructure, and the strategic alignment to be the face of next-generation transport for that global event. Before we conclude, let's talk about the institutional ownership. This isn't just a retail-driven stock. Over 34% of the company is held by institutions. Stellantis is the largest shareholder with a 14% stake. You'll find ACHR and numerous Fidelity